Warren Buffett built one of the most successful investment records in history, and he did so with principles that almost look boring on the outside. The mistake that so many people make is they try to copy Warren Buffett's stock picks instead of looking at his thinking. I'm Michael Baker, and in this video, I'm going to take some of Warren Buffett's timeless principles and translate them into retirement planning principles so that you can base your future on principled thinking and not hype and headlines. Let's get into it. Here's a mistake that I see over and over and over again. People in their 40s, 50s, and 60s are drowning in information. We live in this information age where everybody has a supercomputer in their pocket that constantly dings and alerts them with the latest headlines. There are blogs, YouTube videos, stuff on TikTok, stuff on Instagram. Social media is full of information and people are absolutely drowning. What happens as a result of all this? Well, we see a lot of disorganization in people's lives. People have even forgotten about investment accounts that they used to own. They're clinging to every little piece of the news cycle, feeling this compulsion that whenever markets get volatile, that they need to do something. Deep down, this is not a strategy, but it feels like a strategy because there's this urge to react. Meanwhile, one of the most admired investors in history, Warren Buffett, has preached patience, discipline, and simplicity for decades. Many people's retirement plan looks nothing like that. One of the big mistakes that people, I think, mischaracterize with Buffett is Buffett was not a day trader. Warren and his team were never glued to tickers. In fact, he's notoriously famous for his simple investment ethos. Buy businesses you understand at a reasonable price and let time and compounding do the work for you. A few of his famous ideas. Rule number 1, never lose money. Rule number 2, don't forget rule number 1. Be greedy when others are fearful, and be fearful when others are greedy. Stay within your circle of competence. None of these are about picking or moving into the next hot thing. It's about building a process and sticking to it and executing over time. That type of mindset is exactly what's missing in many people's retirement plan. So let's dig into this. Rule number 1, don't lose money. This means respect risk when you're in the retirement red zone. 5 years prior to your retirement date and really 5 to 10 years after you retire, this is a very sensitive time for people who are planning and preparing for retirement. Buffett's don't lose money rule isn't about never seeing your account balance decline. It's about avoiding permanent capital loss and unnecessary damage. In retirement terms, this means avoiding capital risk when you don't have the capacity to take significant market losses, or you don't have the time left to recover from market losses. Don't take equity risk with funds that you're going to need for income in just the next couple of years. You need to make sure that you've mapped out a clear path for those retirement paychecks. And lastly, and perhaps most importantly, this involves having an actual plan and a process that can help you avoid having to sell positions at precisely the wrong time. Be fearful when others are greedy and be greedy when others are fearful. This is a contrarian mindset to investing, but to me, you need to stop letting the crowd drive your investment decisions. Run your own race. Each and every one of us speaks money in a different way. We also have very unique values and goals in life. It's really important that you don't try to take someone else's blueprint and apply that to your life. So what does this mean when it comes to retirement? Well, first, it means you don't abandon your plan just because markets get volatile and there's fear in the streets. Investing requires patience and discipline. We're not trying to microwave our way to wealth. What we're trying to do is make our wealth last, protect it so that it can protect our lifestyle. You also don't let crowds decide your goals for you. You and your partner, you and your spouse, you and your loved ones, whoever is involved in your economic ecosystem, right? You are the ones that matter the most. So you need to plan and prepare for things that you value, the experiences that you want, the lifestyle that you want. That is what your retirement income plan needs to reflect, not the opinions of others. Warren Buffett is famous for telling people to stay within their circle of competence, and he applies that thinking to himself also. In fact, he's notorious for not wanting to invest in businesses or sectors that he doesn't understand. Let's start with the elephant in the room. Many people are being told that they don't need an advisor, that they don't need help, that they can just do it themselves. Well, I would argue that if you've spent 20, 30 years of your life perfecting a craft that doesn't involve retirement income planning or chief financial officer duties or financial analysis, you might very well benefit from a competent advisor that can help you structure a retirement income plan. Retirement income planning is significantly different than the type of planning and investing you need to do during your accumulation years. Building a nest egg in your accumulation years is not the same skill set that is required for protecting that nest egg and turning it into cash flow in retirement. Warren Buffett valued simplicity. So for retirees, let's look at a couple of ideas where circle of competence and simplicity can really serve you in your retirement income journey. First, consider using portfolios that you yourself can understand on a basic level. This doesn't mean that you need to be a financial analyst, but it also should mean that it's simple enough for you to understand. Many people fall into this trap that complexity equals good, and that's not necessarily the case. Sure, there are some strategies and products out there that offer some unique opportunities, and they're complicated. But that's not necessarily what most people need in retirement. I would argue that many people need simplicity, a plan that they can embrace as their own and that they can understand. Because the more about your plan that you understand, in my view, that makes it easier to stick with your plan through thick and thin. Next, I think you should have a withdrawal strategy or a cash flow strategy that's simple enough for you to explain it yourself. If your strategy is overly complicated, and again, complexity is not always a bad thing, but in my view, if you can make it more simple, make it more simple. And lastly, and this is a big one, an income or retirement strategy that doesn't require you to be a full-time trader or constantly glued to computer monitors in retirement. Now, I get it. There are some people that absolutely enjoy that, but you might be married to somebody who doesn't want to spend their retirement years with you in the other room glued to a computer monitor. So I would argue that having a plan that is simple enough for you to understand, a cash flow strategy that's simple enough to explain, and an investment strategy that's simple enough for you to be hands off and allow time and compounding to do the work is likely going to be a very, very strong strategy for retirement. One last thing that Buffett often talks about is having a margin of safety. How can we apply this margin of safety thinking for retirement income plan? Well, first, anytime you put together a plan, I think it's very important that you don't just assume the rosiest investment road ahead, right? Or the rosiest returns that you can. Markets can be very unpredictable in the short run. So you need to have some resiliency built into your plan. What's your margin of safety? If the market were to decline 40% next year, are you prepared? Are you investing in a way where you could absorb that and your plan would not be derailed? Also, you need to build in some buffers. Things for healthcare expenses, healthcare expense shocks. Inflation is very much a very real phenomenon, and a policy error or mistake could drive inflation up. So you need to be thinking about the cost and the weight of inflation on your overall retirement plan from the very beginning. Do you have a buffer or a war chest of some kind set aside that if something were to happen unexpectedly, you could absorb that and not be forced into selling assets at perhaps the wrong time? If you're hearing this or watching this and you're realizing that your retirement looks more like chasing ideas than following a plan or principles, you're not alone. For most of your investment journey up until this point, most of what people are taught is how to pick investments or the way they should be thinking about investing, and not actually building a framework or a process, especially one that's going to carry them to and through their retirement. Here's what you can do next. Use the link in the description to schedule a retirement review with my team. We'll walk through your current accounts, your goals, we'll learn what retirement looks like for you, and we'll help you evaluate if you actually have a plan in place that's keeping you on track, or if you're in need for a strategy that's going to make sure you reach your retirement income goals. This isn't about trying to turn your portfolio into a mini Berkshire Hathaway or have a Warren Buffett-style investment strategy applied to your life. This is about applying principles and a framework to help you retire on time and on your terms. And hey, if you like this mix of how we can use financial lessons and wisdom from people like Warren Buffett and Charlie Munger and Jeff Bezos and these great investors and entrepreneurs of our time, click that like button, support the channel, and we'll see you next time.